Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Madison Mills, alongside Julie Hyman. Let's get you the three things you need to know today.
First up, President Trump announcing sweeping tariffs on all exports to the U.S. at a level not seen in a century.
This will be indeed the golden age of America. It's coming back, and we're going to come back very strongly.
Trump announced Wednesday he will apply at least a 10% tariff on all exports to the U.S., with even higher duties on some nations to counter large trade imbalances with the U.S. that include some of the country's biggest trading partners like China, which now faces a tariff of above 50% on many goods. China vowed to retaliate against the tariffs, urging the U.S. to, quote, immediately cancel the levies and resolve trade differences. Meanwhile, France is pushing for the European Union to hit U.S. tech companies in response to the tariffs. For now, the new measures don't include Canada and Mexico, which are embroiled in a separate on and off tariff dispute with the U.S.
And global stocks plunging amid the tariff announcement. U.S. stock futures bearing the brunt of the selling this morning, with big tech amongst the biggest laggards. Gold is off of its highs, slightly down after hitting a record as investors seek safety. Meantime, 10-year Treasury yields dropping to the lowest level in more than 5 months. Also, oil futures sinking as the demand outlook weakens.
Plus, taking a look at the companies and sectors that could be most affected this morning. Apple is leading those big tech losses as its global supply chain is hit by these sweeping tariffs. Retailers taking a hit. Nike, Deckers, Lululemon, and more are selling off as their supply chains face high levies. And automakers selling off as tariffs on all car imports into the U.S. go into effect today, with additional tariffs on parts looming over the sector. Although imported cars and parts are exempt from the so-called reciprocal tariffs, car makers are already reeling from Trump's escalating trade war. U.S. stock futures are plunging this morning after President Trump's sweeping tariff plan ratcheted up global trade tensions and fears of slowing growth. Here with the details on what was announced yesterday, we've got Yahoo Finance's Jennifer Schonberger. Good morning, Jennifer.
Good morning, Julie. President Trump levying the most aggressive tariffs in 100 years, calling it an important day in American history, declaring it a day of American economic independence that will make the U.S. wealthy again.
We will supercharge our domestic industrial base. We will pry open foreign markets and break down foreign trade barriers. And ultimately, more production at home will mean stronger competition and lower prices for consumers. This will be indeed the golden age of America. It's coming back, and we're going to come back very strongly.
The president is imposing a baseline tariff of 10% on all countries, which will kick in on April 5th at 12:01 a.m. Then on April 9th, that number will ratchet up to a customized tariff rate called the reciprocal rate on what the administration calls the U.S.'s worst offenders. There are about 160 countries facing those so-called reciprocal tariffs. The reciprocal rate is calculated as the sum of all unfair trade practices, including tariffs and non-tariff barriers like intellectual property theft, VATs, and dumping. Then officials will impose 50% of whatever that reciprocal rate is, so that rate will be halved. Now, those reciprocal rates will come on top of already outstanding tariffs. Most of those actions taken under the Emergency Economic Powers Act aimed at clamping down on illegal border crossings as well as fentanyl smuggled into this country. So looking at some examples here, China's reciprocal tax rate is calculated as 67%, but that is halved to 34%. Then, because China is subject to 20% tariffs under the emergency powers already, the total rate jumps to 54%. Meanwhile, the EU faces a tariff of 39%, which is cut to 20%, while Vietnam faces a 90% tariff, which is cut to 46%. Meanwhile, nothing has changed on Canada and Mexico. They are still subject to the carve-out on the U.S., Canada-Mexico agreement. Under that agreement, there are 0% tariffs unless they are not compliant with that agreement, which means they are then subject to 25% tariffs, though there is still a 10% tariff on Canadian potash. Now, this is not the end of tariffs. Senior White House officials have said that more tariffs will be coming under Section 232 on copper and lumber, as well as a different tariff regime on critical minerals, semiconductors, and pharmaceuticals. Today, just one day after announcing these aggressive tariffs, the president heads to his golf club in Doral in Miami. After that, he will head to Mar-a-Lago, where he will overnight. Back to you.
Jennifer, thank you so much. Futures are plunging on fears of a global trade war as President Trump announces sweeping new tariffs, announcing 10% tariffs on nearly all goods coming into the U.S. and additional duties for nations the administration is considering to be the worst offenders on trade. Here with us now, Yahoo Finance's Josh Schaefer and our executive editor, Brian Sazi. Josh, let's start with you. I can't find a positive note to save my life this morning. What are you hearing in terms of the economic outlook?
I agree with you, Maddie. There's not a lot of positivity out there, right? So I think high level, important to understand essentially what economists are saying about the tariffs. The high level take would be it would push inflation up, it would slow economic growth, the combination of those two things, and specifically how much it would slow economic growth. Economists are arguing recession risks are rising. I think you're seeing that perhaps being priced in to the stock market right now when you take a look at equity futures and you see S&P 500 futures down about 3%. So again, mechanically, sort of how that works, consumers would have less purchasing power. That's going to, one, hurt their income as businesses make less money. Two, it's going to hurt their eventual spending. Maybe that leads to a close to a recession, if not a recession, later this year. Then you spin that over to the equity market. We have a lot of our bulls over the last year now saying, I'm thinking a little bit more about my bear case, right? So you have Evercore ISI, RBC Capital Markets, and Citi all still have S&P 500 targets north of 6,000 on the S&P 500. All of them saying my bull case does not look nearly as strong now. I'm starting to think about the bear case and sort of laying out what that could look like. I'll highlight one from Evercore ISI's Julian Emanuel. He said retaliatory tariffs will open further near-term downside for stocks, potentially testing the 200-week moving average of the S&P 500 at 4,677. So again, overall, just a little bit of a bleak outlook. Saz, I don't know if you had any more
guys, hold on a second. We're all talking very calmly about it. This is absolutely bonkers. Let's just take a moment, right? This is far worse than any of the market participants we've been speaking with had expected. Peter Bookvar, who's a strategist I follow, sent out a daily email this morning, said, this current approach is going to literally freeze global trade. He also said the belief that a trade deficit is bad is completely flawed. That's how they calculated these things. They just looked at the trade deficit between the U.S. and all these other countries in goods specifically, not even in services, which is something that we export much more of. And they cut it in half, and that's the tariff.
Well, that's why you have the team at RedMac calling this Obliteration Day. And I know they're trying to make light of it, but to your point, this is a full-on disaster. You look at, I know I'm supposed to mention a quote here from my contact, Peter Williams. He's calling this a shock to growth. Says a lot of uncertainty, saying we resolve some of that uncertainty, but the outlook is even worse. Peter pulling no punches in his comments this morning, but I really want to lock in on what Julie just said on this being really, really bad and why you're seeing some of these sell-offs, these major sell-offs in retailers, Nike, Walmart, Amazon. I know everybody wants to talk about cloud services. That stock's selling off. This is horrible because prices are going to go up likely significantly in the wake of these tariffs. Why? Because you look at Nike, 44% of its sourcing comes from Vietnam, 11% China. Put those two numbers together, I can still do some math in real time. That's 55% of its business. They are relying on these two countries to get products, and they have been for decades. Essentially, you and I, Josh, talked about this late last night when we were both here at HQ. This fundamentally changes the investment decision on Nike because it uproots the complete business model for this company that they have minted money for decades.
And by the way, they had already uprooted it. The reason that they get 44% of that from Vietnam is because before it was even more exposed to China. And when they had the first round of tariffs, they then, like many other retailers and footwear companies, moved to Vietnam.
Apple, right?
You're not hiding out in Vietnam, and that's the other vibe. You go into these platforms, you see the stock research and these strategists. You watch this stuff, Josh, too. There's nowhere to hide. That's the other thing. A lot of companies,
I just wanted to quickly mention that Deutsche Bank is talking about the U.S. dollar, saying the safe haven properties of the dollar are being eroded. We have gold coming off of its highs. We have Walmart down today because of their China exposure. Where do you hide in this market, even as the 10-year yield is coming down?
You look for a safe haven real quick. Procter & Gamble, they make Tide. Well, they have a huge operation in China that makes diapers. That business is not going to go impacted? Hell yeah, it is. So is it a safe haven play? Probably not anymore.
Well, and the other thing we haven't even brought up here, we don't know how the other countries are going to respond yet, right? And that's the big thing that I think people are circling when you talk about a place to hide and, okay, stocks are down 3-4% at the major index level, individual names down 10%, where do I go shopping? No one wants to go shopping right now in these names because it might just get worse, right? How do these countries actually retaliate? Are there discussions over the next week before most of the large tariffs are put in place? Is it unwound? That's just a looming question right now that no one knows the answer to. So I'm not sure you're going to see a lot of dip buying like you've seen in a lot of these sells.
And one other thing I want to say is that, a lot of market participants have said they've been upset about the sequencing. The tariffs are coming first, but a lot of people still say, well, we still expect the deregulation. We still expect tax cuts to be coming. And you have to wonder if all of those calculuses are also going to be fundamentally rewritten. I mean, J.D. Vance, the vice president, this morning in an interview with Fox News saying tax cuts won't be a way to offset tariffs. Well, that's a pretty scary thing to say.
It's just an extension of tax cuts that were already in
that's
place.
The problem here, guys, because you can't chart a path out of this. It's unclear when these tariffs lift. It's unclear how these tariffs will impact corporate profits in the fourth quarter of this year. So if you can't see your way through the fog, I mean, how do you invest? And that's why I'm seeing some analysts on the street saying some of these names in apparel, for example, are uninvestable. You just don't buy these names. And if you own them, get the hell out. I mean, we're not trying to sow panic here, but this is a major change in the narrative on how you approach investing.
Long term, the gravitational pull is still upward in the stock market for those people worried about their 401ks this morning. I think that's probably important to note. Depends on the time horizon.
Historically, it has been.
Historically, it has been. Yes.
All right. Brian Sozzi, Josh Schaefer, thank you so much.
Yeah, thank you guys.
Well, global markets are falling in response to President Trump's latest round of tariffs as world leaders prepare their responses. EU President Ursula von der Leyen calling the tariffs a major blow to the global economy and said countermeasures would be incoming.
Let's be clear-eyed about the immense consequences. The global economy will massively suffer. Uncertainty will spiral and trigger the rise of further protectionism. We have always been ready to negotiate with the United States to remove the remaining barriers to transatlantic trade. At the same time, we are prepared to respond.
Joining us now is Michael Froman, president of the Council on Foreign Relations and former trade representative under the Obama administration. Mike, thank you so much for joining us. Is it an exaggeration to say that this is a fundamental, upsetting the apple cart, remaking of the global trade order, if it does persist like this?
No, I don't think that is an exaggeration. I think it's exactly what President Trump intended. He has a focus on trying to reindustrialize the United States and believes that the best way of doing that is to create this tariff wall, which will help compel companies to move their production, move their supply chains to the United States. I think the challenge is that as these tariffs go into place and as retaliation goes into place, the pain of this approach is going to be affect everybody. Everyone's going to feel effect, whether it's through the stock market and their retirement savings or paying more at the checkout counter for everything that they buy, or manufacturers looking for inputs that can maintain competitiveness, and those are being more expensive. Everyone's going to feel the pain, and maybe over several years, some companies will move production to the United States, but that's a longer-term prospect. Right now, companies are standing by the sidelines waiting to deploy capital because, as you said, they don't know how long these tariffs are going to be in place, whether there's another shoe to drop, and you don't make these kinds of big capital allocation decisions on the basis of tariffs being applied in the morning and taken off in the afternoon.
Mike, it seems like the market is still holding on to some hope that there is negotiation here. If not, we might be seeing even more selling than we already are this morning. In your view, based on your experience in the room with these tariff negotiations in the past, where are the areas of negotiation? What are the metrics to get any of these tariffs removed?
So the best case scenario is that the president really intends to use this as leverage. And as Ursula von der Leyen just said, they're willing to negotiate. And there are barriers. The Europeans have higher tariffs on our products than we have on theirs. There are a number of non-tariff barriers, issues that have been irritants in the relationship for a long time. Maybe some of those will be removed. That's the best case scenario. But every country has its own politics, and every politician needs to respond in a way that demonstrates that they're defending the interests of their constituents. And so I expect to see retaliation. I expect to see escalation. And once tariffs are put in place, they're very hard to get rid of because you have constituencies that then have a vested interest in keeping them. We saw that the Biden administration inherited a number of tariffs that the first Trump administration put on China. They reviewed them for 3 years, and they didn't end up eliminating any. And so I think it's very difficult once tariffs are put in place to eliminate them when constituencies get quite used to it.
Obviously, these are trade and economic measures, but what does it look like from a geopolitical perspective as well? What's the kind of bleed over, and what does it mean for the relationship? I mean, we already have seen, obviously, the relationship between the U.S. and Canada, for example, fundamentally damaged. What about in terms of U.S. standing in the world?
Well, it has a fundamental impact on the way we're perceived by not only foreign governments, but by foreign populations around the United States. You mentioned Canada. I think the Canadians are quite bewildered trying to figure out what they have done to deserve this approach by the administration and what they need to do to get out of the doghouse. There are outstanding trade issues that they should resolve, whether it's around dairy or softwood lumber or digital services. So there are things to work on, but I think they feel like the U.S. has really undervalued the relationship that's been built up over decades with many of these countries, sometimes over centuries, around alliances. And I think that's going to be very difficult to reconstruct, because even if the tariffs come down, there's now a lack of trust with the U.S. And that's hard to demonstrate U.S. leadership when our closest allies don't trust us.
Mike, let's say that this sticks. I know you're on the board of Disney. You've obviously been at MasterCard. You have connections in the corporate world. How are companies potentially going to respond, and how bad could this be for consumers in terms of price increases?
Well, I think it's going to depend product by product, really. But a lot of these businesses are operating on narrow margins. They'll try and get their suppliers to eat some of the increase. But some of this will end up getting passed on to consumers at a time when they're already inflationary pressures. So I think consumers will see higher prices really across the board. And this administration has said that's okay. This is a pain worth going through in order to reach this golden age of America, which has greater manufacturing capacity and industrial capacity. I think the Treasury Secretary was quoted as saying something along the lines of, cheap consumer goods is not the American dream. So American consumers are going to feel this, at least in the short run. And over time, we'll see whether the production moves to the United States and whether the job creation that comes along with that, if it does come, compensates for that.
Mike, you recently wrote a really intriguing piece in Foreign Affairs where you basically said the U.S. has become more like China in its approach to these types of issues. What does that imply about how this is all going to turn out, about the end game here for the Trump administration?
Well, for years, we encouraged China not to be protectionist, not to apply tariffs or other barriers to our exports. We encouraged them not to restrict foreign investment, to let American companies invest as they wished in that market. And we encouraged them not to subsidize industries or engage in industrial policy. Lo and behold, we had only modest success, I think, in trying to get China to change its approach. And so instead, the U.S. is now being protectionist and keeping products out of our market, restricting foreign investment inward and outward with regards to China, and engaging in industrial policy, whether it's the IRA and clean energy or the CHIPS Act. Yeah. I think the challenge is we're now competing with China on a playing field that is defined by their set of rules. And the question is whether we can compete as well, if not better, than they can on those terms. I have my doubts, particularly around industrial policy, because they seem to be able to deploy unlimited amounts of capital behind priority technologies. And I don't think we have the consensus to do that going forward. So, having spent 80 years developing a global trading system, which basically reflected our interests and our values, and getting China to try and play according to those, sometimes with success and sometimes frustratingly without success, we're now playing on their field.
Mike, 30 seconds left. To what extent does this increase the risk of a recession in your view?
Well, I think it does. I mean, you can't undo the law of economics through an executive order. So when you raise prices by imposing a tax, and that's exactly what a tariff is, you're going to have less demand for a product. And when you combine lower demand with reduced consumer confidence, reduced investor confidence, I think the risk of recession goes up.
All right, Michael, thank you so much for joining us this morning. Really great breakdown for our audience. Appreciate your
Thanks for
time.
having me.
Coming up here on Morning Brief, we'll break down the sectors and stocks to watch and count you down to the opening bell on Wall Street as stocks are plunging pre-market open amid President Trump's sweeping tariffs policy. We'll be back with more. President Trump introduced a slew of country-specific retaliatory tariffs set to take effect on April 9th. While sector-specific tariffs were not a part of the announcement, they're certainly taking a hit today, at least the stocks related to those sectors. So let's break it down. Our Yahoo Finance reporters are taking a deeper look at technology, retailers, and autos. Let's kick it off with tech, with Apple taking the steepest losses among the Mag 7 so far pre-market here. Allie, let's get over to you. What else are we seeing in the tech trade?
Yeah, Maddie, it's a sea of red in futures trading right now. You mentioned Apple, we're down over 7% in extended trading. Now, if these levels hold at the open, it will be the largest intraday drop since September 3rd, 2020. So that just gives some context on how spooked investors are right now. Apple's overseas production hubs are particularly vulnerable to these tariff countries, given the presence in nations like China, Vietnam, and India. In fact, Apple has actually relocated some of its manufacturing facilities out of China amid these tensions with the U.S. But clearly, with these new tariffs now in play, there's just nowhere to hide right now. We see other Magnificent Seven names also under pressure. Amazon, another big name, down 7%. Alphabet off just around 4%. Meta 6%. Microsoft down 3%. Now, as a reminder, if we take a look at some of the countries that will be most impacted, that a lot of these tech and semiconductor names are most exposed to, we have 34% additional tariffs on China. Now, that's on top of the 20% levies that are currently in place. 32% on Taiwan, 46% on Vietnam, 26% on India, 36% on Thailand. Now, the Taiwan government did respond to these tariffs earlier today. They said that the levies were unreasonable. They plan to reach out to the White House to negotiate. Now, within tech, it's worth noting that semiconductors are one of the few items exempt from additional tariffs, but we're still seeing some significant selling pressure there. If we flip over to a semis board on extended trading, you're going to see that names like Broadcom, similar to NVIDIA, off 7%. NVIDIA, one of the big leaders of the bull market over the past 2 years, just down 6%. TSM also down 6%. And this is because analysts have warned that despite the exemptions, there are still negative implications for the entire semi sector, particularly when we think about end demand for PCs, iPhones, and the significant amount of manufacturing that's done within China. Some analysts have said that NVIDIA, and to a lesser extent Broadcom, they could potentially be insulated due to the fact that their clients are these big hyperscalers. They're spending a lot on AI, really growth at any cost. But there's also been some talk that no one's really talking about bringing manufacturing into the U.S. because many of these companies don't think that these tariffs will actually stick. So that's the next point here, is that the negotiation table, that's going to be a big focus. We'll see if anything can get done before these additional tariffs are set to come into play April 9th. Back to you guys.
Thanks, Allie. Appreciate it. Shifting gears now to retail. Stocks there taking hefty losses following the tariff announcement, and Brooke DePalma has more. Brooke?
Good morning, Julie. Well, one analyst is saying you might want to rethink investments in specialty apparel as these tariffs take effect. That Stifel analyst Jim Duffy told clients in a note this morning, quote, until visibility improves, we expect investors show very little appetite for investment in our coverage universe. Think Nike, think Lululemon. Those are among the hardest hit this morning. Shares of both sliding in the pre-market trading as investors really digest the impact that these reciprocal tariffs will have on the countries that both Nike and Lululemon source from. Taking a closer look, Nike, 11% of its products are sourced from China, 44% from Vietnam. On the flip side, for Lululemon, 42% of products were manufactured in Vietnam, 16% in Cambodia, both of which they went to in order to offset that impact in China. Now, China is facing a 34% reciprocal tariff here. Once again, that's on top of the 20% tariff that's already in place. Vietnam facing a 46% reciprocal tariff, and Cambodia 49%. And on top of that, away from specialty retail and into discount discount. Dollar Tree caught my eye this morning. It's a place where many low-income shoppers are relying on right now. Direct imports made up 41% to 43% of Dollar Tree's total retail value purchases, and China supplies the majority of those imports.
All right, Brooke, thanks so much for breaking that down for us. Finally, international automakers mostly lower this morning following the implementation of those previously announced 25% tariffs on all imported vehicles. Praz Subramanian here with more. Praz, what are you looking at?
Yeah, a couple of interesting things kind of hit the inbox and try to hit the reports here. First off, I want to talk about VW. They're actually going to add an import fee to the window sticker to their cars, right? That's how they're responding. We heard price hikes are coming from certain automakers, but we're going to see that import fee, and they're also going to keep certain rail shipments from Mexico in Mexico for now, and they're going to also keep certain cars in ports until they can figure out what to do with them that are subject to tariffs. Ford, on the flip side, is offering employee pricing to all Americans here. They're actually going to reduce prices, believe it or not. I think it's an interesting move from a marketing point of view. Is it a goodwill gesture to the Americans that are supposed to be suffering from price hikes? Is it a marketing gimmick? We're hearing all kinds of responses to that move, but I think it's good for Ford in terms of they have a lot of inventory to get through. The question is what happens in June. And finally, we're seeing GM not responding to tariffs just quite yet. And as Stellantis said, we're not going to implement price hikes just quite yet, but they are idling production. We just confirmed at 2 plants, one in Mexico and one in Canada.
All right, thanks, Praz. Appreciate it. We got all your markets action and the open just ahead. Stay tuned. You're watching Morning Brief. We just had the opening bell, so let's do a check on the markets here. Stocks are dropping sharply right from the gate. That's after we got the tariff announcement from President Trump late yesterday after the market close. That was much worse than most market participants had anticipated. And as Maddie pointed out earlier, you're hard pressed to find any kind of positive or not negative reaction amongst all of the analysts and strategists and economists' notes this morning. There is deep consternation about the announcements that we got on tariffs that on many countries, from China to Vietnam, many of them in Asia, even the EU, are higher than anticipated. The Dow out of the gate here, falling by 1,160 points. That's a drop of 2.75%. The S&P 500 down 3.25%, and the Nasdaq Composite is down 4.3% as well. And really, we are seeing selling across the board here this morning. Even the places that have been refuges for investors in recent months, like gold, are falling. One of the few places that's catching a bid, Treasuries this morning, that's pushing yields down. Jared Blickery has got a deeper look at what's going on here. Hey, Jared.
Thank you, Julie. I have a bunch of comps and superlatives here, but I just want to start by showing the price action year to date with the Nasdaq Composite here. You can see it's opening at the lowest levels of the year. In fact, you'd have to go back to September to find where these markets were trading, and that goes for the Dow and the S&P 500 too. And by the way, let's check out the S&P 600. That's small caps. That is nearing a bear market, so we'll keep an eye on that. Russell 2000, very similar situation. Julie, you just mentioned the bond market, so I'll show you the 10-year T-note yield. That is dropping the most since August, 18 basis points. That was Yen-mageddon back then. That was kind of a one-off event that had to do with the Japanese yen. Well, this is very much globally centric here, and we can also see the U.S. dollar falling as well. Dixie is down the most since November of 2022. And I've been talking about how the dollar and yields have been going the opposite direction. Not today. They are both going down significantly. And let's check out some of the sector maps, and then we'll get into some heat maps. This is what is happening today. So you're seeing a little bit of green. Staples, utilities, healthcare in the green. Consumer discretionary, that's Amazon and Tesla. Then you have tech and energy, all of those down by more than 4%. And energy has kind of been a bright spot this year. If we take a real quick look at the year-to-date totals, let's see if energy is still in the green, and it might take a little bit of time to load this. So if that's not going to pull up here, I'm just going to move on because I do want to show you the NASDAQ 100. We're seeing a lot of deep sell-off here. Apple down 8%. Well, there we go. Apple down 8%. And that is worth about over $250 billion in losses if we were to carry that into the close. And that's on a market cap basis. Also seeing Amazon helping to lead down there. Tesla, which got a nice bump up yesterday, that's down 4%. And then we can take a look at some of the industries within tech. Here's software. IGV, that's a software ETF, that is about to enter a bear market. So software stocks in a bear market, or almost in a bear market. We got to wait till the close. Semiconductors have been in a bear market for several weeks, if not a month or so. You can see NVIDIA down 5% here. A lot of these names down a little bit more than that. ARM down 6%. And then let's take a look inside small tech. This is a disruption. And this is where we're really seeing a lot of losses, deep losses. Shopify, very retail centric, that's down 15%. Roku down almost 10%. You down about 8% there. And then let's take a look at the futures market because we're seeing a lot of red there. Silver leading the way down 7.8%. It is falling the most since February of 21. We can also see crypto having a negative reaction, but not outsized. Bitcoin is a relative leader here. It is only down 2.89%. So that's not a terrible thing for Bitcoin. If you want to see a couple of green screens here, let's see if I can find, yes, some consumer staples. Here's beverage. So we're seeing Coca-Cola and Pepsi. I did mention staples, the sector overall catching a bid. So we're seeing that kind of continue here. We can also see food stocks, a little bit of green there. So these defensive moves are kind of like a ray of hope here. Sometimes when you see deep sell-offs and everything, including the staples, get sold off, that's indicative of panic selling. We are not seeing panic selling just yet. And I'll send it back to you with a little bit of green behind me.
All right, Jared, thanks so much for breaking that down for us. Appreciate it. It's time now for today's strategy session. U.S. stocks plunging at the open today amid President Trump's sweeping tariff announcements. The S&P 500 dropping by the most since January of 2022 this morning. So what is next for the market? Joining us now, we've got Peter Chur, Academy Securities Head of Macro Strategy. Peter, great to have you on set with us on a big morning here. I want to pull up a chart looking at the S&P 500 for the first 100 days of Donald Trump in office. You can see that green chart at the bottom there indicating Trump's second term in office, underperforming both Biden, first era Trump, and Obama's second term as well. What does it take for the market to recover from where we're at right now?
I think we need a change in policy. I think we've been, there's a lot of talk about how other countries don't understand the cards they have. I think the U.S. has overestimated the cards. I look at this and I look at the tariff. We are picking a fight with $80 trillion. Yes, the U.S. is the biggest economy, call it $30 trillion, but we've chosen to fight with $80 trillion. That's generally not a good way to win. And I think the expectation is within the White House, we're going to get all these calls from all these countries now desperate to fix. I think that's not how it is. I think countries have learned to play Trump very differently than Trump 1.0. If you look at Xi was the first one to come to Mar-a-Lago last time, right? And every time they mentioned tariffs, Xi and there was a Chinese delegation. This time, yeah, sure, 10% we'll take it. Sure, another 10%, we will take it. There's been no comeback. Yeah. And I think what you're going to see is the world sit back, watch Trump stew. I think we're going to see inflation pressures from these tariffs. I think they're going to have to cut some or give more emergency deals like they did on potash and things like that to farmers. As we struggle, instead of coming to the table, Europe's going to come and say, hey, we're going to put 20% on your services. And I think we've misplayed our hand horribly this time. And I think unless there's a real change in working together with the world, I think this pressure keeps coming on the markets, unfortunately.
So what do you do? I was struck by Bank of America's Savita Subramanian, the title of her note this morning, there is no tariff playbook. That as an investor, it's really hard to figure out what to do here. So what do you do?
So right now, today, I'm going to be adding a little bit to Chinese stocks. So whether it's FXI, KWEB, maybe A-share as the three ETFs, I think China winds up, unfortunately, being a beneficiary of this. It's not what I would have wanted, what I expected, but when you look at this, who has excess capacity? China. Who needs all these raw resources that other countries are getting tariffed on? China. So I think they become a beneficiary of this. I think it's a strategic mistake that this happens. And then domestically, I think I might try and buy one or two of the chip stocks that are building foundries here. It's the only kind of bright spot I see is we're going to need foundries here. Some companies have a head start on this. I know, there's been talk about big buildups in foreign investments. That's going to take years. So I'm looking for the companies that have already started foundries here, and I think I'm going to buy some of those. Nibble, I own them. I sold them off a little bit ahead of this. That's probably the one bright spot I see.
And I wonder how that informs how you're thinking about tech right now. We had Treasury Secretary Scott Bessent telling Bloomberg that the sell-off is related to what happened with DeepSeek and not anything related to tariffs. How are you thinking about tech right now?
I think it's kind of this combination of storms. One, did we already build out too many AI data centers? It reminds me a little bit of fiber, where in the early 2000s, we built out a lot of fiber. Eventually, it all did well, but a bunch of companies went bankrupt, so we'd overbuilt. I see a bit of that going on. I see China making some progress. And again, I see these tariffs. China doesn't have tariffs with Taiwan. China doesn't have tariffs with this. So yes, there's some trade embargoes and things like that. I think we are just feeding this and handing too much to China at a very delicate time. So I think, yes, DeepSeek has part of it, but it's only part of the story. And again, this isolationist. I keep coming back, and this is unfortunate to me, but I think we are destroying the American brand. And I'm not sure we can go back to fixing it if we continue much further down this path.
Peter, I always like talking to you because of where you work, which is Academy Securities, which manages money and has on its staff a lot of veterans, people who have military backgrounds. And I'm curious what you're hearing from them about this current moment, not just the trade strategy, but some of the military implications as well.
Yeah, so it's been really interesting. Yes, about half the firm is veterans, and we have about 30 retired generals, admirals, including a couple from the UK, as well as 2 former CIA officers. You can never quite tell with the CIA people. But yeah, I think there's some concern about the messaging. How are we doing this? And I think at some level, and I think this applies to me on the economic side, everything we're seeing geopolitically, the what doesn't bother people necessarily. Some of the points that are trying to be made are valid. It's how we go about it that's causing problems. And the one thing to me that I can't get out of my head is if you told me 3 months ago Germany was going to invest heavily in military, the US defense manufacturing stock should have skyrocketed.
Right.
We have done something that Europe does not trust buying US military equipment the way they once did. I'm sure they'll still buy some of it because of need. But that's those things that are broken. And again, to me, it's like you have this relationship, and every once in a while someone says something that you can't really pull back. I feel that that's where the U.S. has gone on this, and people don't trust us as deal makers. And I think I'm very concerned that we are doing this deglobalization, and it's going to continue. And this is probably more cynical than I am, but I keep pulling up the chart of the Nikkei, and you look at the Nikkei back in 1989, top of the world, right? Japan, everything's going to be great.
Yeah.
It fell 50 some odd percent there and took 30 some odd years to recover. Did anyone in Japan think, oh, we're about to lose our exceptionalism? That to me is the concern here, that we are overplaying our hand, we're alienating people, we're having too many fights, and I think this can continue. So my change has to be something coming out of DC. I would like to see Bessent more in control. I think Bessent's probably the person who you listen to and people in Wall Street really trust, and he feels like he's been marginalized a little bit. So I think if he
and he maybe hasn't done himself any favors when he has spoken.
Yeah, so I think we need some sort of change and some realization that, first, America was pretty darn good before, right? I know on Make America Great, but America was pretty darn good. We are talking about American exceptionalism. And I think the mistake we've made is we've so focused on trade data, we missed that we had capital inflows, which were great. Yeah. People loved our brands globally. They brought our brands globally. There was a lot of good going on, and we had to fix some of those things. And this would all work better if we had spare capacity. There is no spare capacity, or minimal spare capacity, so we're not going to get the bump of manufacturing anytime soon. That's where I just feel it's been such a hodgepodge. We need organization, and the how we're doing things is destroying the what.
Peter, thank you so much. Really appreciate it.
Thanks. Sorry, I wish I could be more positive today.
No, it's all right. It's that kind of day. Coming up, President Trump's reciprocal tariffs weighing on commodities as well. How it could affect everything from oil to your morning cup of coffee. That's next on Morning Brief.
Oil slumping this morning as President Trump's new tariffs are expected to hit demand, and OPEC Plus agreeing to increase output in May. Yahoo Finance's Inez Ferre joins us now with a closer look. Hey, Inez.
Hey, Madison. Yeah, and oil is reeling right now, down more than 7%. It was down more than 7% right now, 6.5% when we're talking about WTI futures. Brent crude is also down more than 6%. And this is because of two things. First off, those tariffs that were announced yesterday, you saw oil going down more than 4% on that news. But then we really saw the accelerating losses after OPEC Plus said that its members have agreed to increase output in May, and increase output by more than expected, because they're going to be increasing barrels output to 411,000 more barrels a day into the market. That's what they're going to be introducing throughout the month of May. And that has really spooked the markets as well. So if there was a cold bucket of water to throw more onto the oil market, that was it. Oil was already on the decline because of those tariffs, because analysts have been saying, look, if you're going to have very severe tariffs, then you are going to see oil going down in price because of demand concerns. And Rebecca Babin, the analyst that I spoke to last night, she was saying to me yesterday, look, 54% tariffs on China, that is a significant negative surprise. The tariffs on growing emerging economies that contribute the most to the crude growth in the world, that is significant. And so you are seeing now that demand is taking center stage when it comes to these markets, guys.
You're also watching gold. It's pulling back after hitting that all-time high.
Yeah, look, if we're looking at across the commodity space, we are seeing that gold is also pulling back. It had reached an all-time high last night, but you are now seeing it pull back 1.5%. Out of the commodities, it is doing the best, really, because you're also seeing silver down, copper down, all of this because of demand concerns. But gold isn't holding up to its all-time high from yesterday, but still outperforming when it comes to the other commodities. And analysts had said, if you see stocks coming down, if you see a whole market sell-off, it's likely that you are also going to be seeing some profit taking in gold and also some margin calls. So traders selling anything they can.
Inez, thanks very much.
Thank you.
We got much more markets action ahead. Stay tuned. You're watching Morning Brief. President Trump's hawkish tariff policy took Wall Street by surprise. Nearly 80% of investors surveyed by Wolfe Research said the tariffs were more severe than they had anticipated. How did investors get yesterday so wrong? Joining us now, Tobin Marcus, Wolfe Research head of U.S. policy and politics. Tobin, why was everyone so taken off guard here?
I think the scale of the tariffs that ended up being announced is a little hard to believe even after it's happened. And so it's not terribly shocking to me that investors had a hard time getting their head around the possible scale of this in advance. Our low end of our range of estimates of what this might look like was higher than some of the other point estimates we saw elsewhere on the street. And this came in higher than the high end of our range. So I think it is definitely an adverse surprise, even to our relatively hawkish expectations. Not, I think, shocking that caught some investors flat-footed.
And about half the folks you surveyed think that there's still negotiation hope here moving forward. What are you telling clients about the likelihood of these tariffs being negotiated downward?
So I am somewhat pessimistic about the prospects for negotiation here. I think when you look at the structure of these tariffs, on the one hand, you have the 10% floor, which limits how much relief most countries are realistically going to be able to hope for. And then the way that these reciprocal tariffs were set, these ostensibly reciprocal tariffs, was based on an imputation of the value of the total trade barriers from any given country based on the scale of our trade deficits with that country. So we're essentially treating bilateral trade deficits as a big problem per se, as a national emergency, in the president's words. And that's going to be a really challenging thing for countries to change overnight. You know, no matter what policy concessions they're offering, whether it's lowering tariffs, lowering non-tariff barriers, it's going to be really hard for any of those policy shifts to make a dent in actual trade deficits. And so insofar as that's been the president's target, I think that's going to be a hard thing to move the needle on.
Tobin, just to translate that a little bit for folks who are not as familiar with some of this trade language, basically the trade deficit is the difference between what I sell to you and what you sell to me, effectively, right? That's the trade gap. And I believe that this was just calculated on goods alone, not on services, which is fascinating because the U.S. is sort of much more dominant in services than it is in goods, right? So what does that also say about whether there's any hope for these things to be reduced?
That's exactly right. We run a big global trade deficit when it comes to goods. We import a lot more goods than we export. We run a significant global trade surplus when it comes to services, with education, financial services, some others being major strong points for the U.S. So on the one hand, I think that exposes U.S. tech companies and other service exporters to retaliation. We'll have to see whether or not other countries are willing to cross that bridge. I think retaliating in that way, rather than just retaliating with tit-for-tat tariffs on U.S. goods exports, probably does increase the risk that the U.S. will counter-retaliate, as Secretary Bessent was warning about yesterday. But the president's goal here is a reindustrialization of the country. The way he has articulated what he's trying to achieve here is that the goal here is to effectuate a long-term restructuring of the U.S. economy in which we're rebuilding our industrial base. So I think that's why we're seeing the focus on on goods that we have seen in the structure of this policy.
And we're already getting retaliation announcements from several countries this morning. We're going to throw up a chart right here indicating some of those retaliation efforts that we are seeing from the likes of Germany and France, for example. Here, the EU chief talking about how they are prepared for countermeasures, China and Spain coming out as well this morning. Then Howard Lutnick saying tariffs will go up if a country retaliates. Given that, how bad could these tariffs get if we continue to see the trend we've seen from this morning continue in terms of retaliation?
Yeah, it's really hard to game out exactly how this will go. I do think there is some risk that the tariffs could go up in response to retaliation from other countries, especially if those packages of retaliation include some of these more unorthodox measures like retaliating against U.S. tech companies and other service providers with things like digital services taxes. So I think that is a very sensible concern. Of course, the tariffs imposed yesterday are already immense. So we don't know for sure what appetite the president is going to have to take those further up. But I do think that they will be thinking twice in Brussels and other foreign capitals about exactly how much risk they're willing to take of provoking a further response from the administration. But I think most countries are going to feel like they have to respond somehow. Perhaps not countries like Vietnam, that are just in a really disadvantageous position here. But peer countries and blocs like the EU, I think, are not going to be willing to take this sitting down with no response at all.
Tobin, beyond tariffs, given that the market has gotten this so wrong, as you said, it was tough to get it right. What else are we getting wrong? What else are market participants getting wrong? And I'm thinking in particular of the tax cuts that a lot of investors seem to be pinning their hopes on to sort of rescue us from this tariff situation.
So, starting on tariffs, I think there is still a big question about durability. And frankly, I think that we would be seeing even bigger declines today if investors were assuming that this stuff is going to stay in place. Again, we are somewhat more pessimistic on that front. So I think we're not necessarily past the point of people having excessive optimism about the tariffs. When it comes to the tax cuts, I do think those are coming, likely in a July timeframe for final enactment. There will be some net fiscal impulse, some stimulus that comes out of those in 2025 and 2026. If these tariffs were to stay in place, that fiscal impulse is much smaller than the face value of the tariffs. I mean, a factor of 4, roughly. But, if we start to see too much economic pain from the tariffs, it's possible the administration is capitulating as we get into late Q2, early Q3 in the face of economic weakness driven by these tariffs. If we start to see tariff easing that then leads into the tax cuts being passed, I think that would be the optimistic narrative about how things could turn the corner over the summer.
All right, Tobin, got to leave it there. Thanks so much for joining us this morning.
My pleasure.
That's going to do it for me and Julie this morning for the Morning Brief. Join me in the next hour for more analysis on Catalyst and Julie in Wealth at 11 a.m. Eastern Time. Stick around for more.